An introduction to Forex trading. The currency market is only one part of the huge world of exchange, where everything is a commodity. From wheat to diamonds. It is the world of hopes and disappointments. It is the world of strong and decisive people. To learn about the currency or Forex trading, first we have to know about the history of trading, especially the stock trading. The stock exchange. What is the modern exchange and what is traded here? The modern stock exchange is the highest form in the long evolution of global trade. Merchants and traders were actually developed from working in caravans and noisy bazaars to organizations like stock exchanges. In the Middle Ages, merchants only met at a certain place once a year. The fairs or markets, the nation-states and new trade routes were being developed. New continents were being discovered and new goods appeared on the markets. Cities and populations prospered from this boom trading. In large seaports, like Antwerp, trading began to take place on daily basis, initially in the open air and later in a building specifically designed for this purpose. One of the first European stock exchanges was opened in Antwerp in 1531. Over the years, a set of rules governing exchange trading have grew up, and in the most developed economic nations, these rules are enshrined in law. Modern stock exchanges are the major elements of global economy. The fundamental properties of tradable commodities. Number 1. Liquidity. Liquidity is the most important property of an exchange commodity. Liquidity means that the commodities can be bought and sold freely. Only liquid commodities are allowed on the exchange platform. Number 2. Rating of quality. The second property of an exchange commodity is the precise rating of quality. For example, gold bars must be at least 99.5% pure gold. Petroleum is divided into certain grades. The highest grade is Brent. Number 3. Quantity. The third property of an exchange commodity is an agreed minimum quantity, which can be traded on the exchange platform. This amount is known as a lot. In the precious metals, a lot is measured in troy ounces, each equaling 31.1035 grams. On the Chicago Gold Exchange, the minimum gold lot is 100 ounces. Petroleum is measured in barrels, and on the London Petroleum Exchange, one futures contract is equal to 1,000 barrels. Now the question is, what a currency is measured in? At the London Future Stock Exchange, one lot is equal to 1 million American dollars. Number 4. Fluctuating price. The fourth integral property of an exchange commodity is the fluctuating price, which responds to supply and demand. These levels of supply and demand vary as news reaches the exchange platform from the outside world. Types of exchanges. We have already given examples of things that can be traded. Commodities, like gold, or petrol, or currencies, and of course things like shares and bonds. We are going to divide these things into 3 groups, depending on which exchange trades on them. The first group is the commodity exchanges. Gold, silver, oil, wheat. The second group of exchanges happens in the stock market. Modern stock markets are economic thermometer, measuring the temperature of the global economy. The third group is the currency exchanges. The group we are most interested in. Currency is traded on them. One nation's money is exchanged for another's. We will now focus on the currency market. The global currency system. The Second World War not only changed the political balance of power, it also left both Europe and Japan in ruins. In 1944, financial representatives of the Allies met in Bretton Woods, a small town in the USA. They discussed the problems of post-war financial mechanism and the restoration of global economy. To this end, the International Monetary Fund was founded. America agreed to take the value of the dollar to gold. 1 troy ounce of gold is equal to $35. The dollar had taken the control from the British pound, which should predominate at international payments since the middle of the 19th century. By the early 70s, the global economy was on the upturn. By 1978, a floating currency system had been established. Even so, today the price of metals, petroleum, and international debts are still an American dollar, because for the first 30 years after the war, there was simply no alternative. The dollar as the world reserve currency. There is no doubt that the United States dollar has enjoyed its presidency as the present global reserve because U.S. is the world's largest economy, and because of the key role the Bretton Woods Agreement played in post-war reconstruction. But the time is changing. In 1999, 12 European countries including Germany, France, Italy, and Holland created the new single European currency, the euro. This is without doubt an attempt to create an alternative global monetary unit. and we have Chinese currency as the currency of one of the other world's large economy. Money as a commodity. It is possible to buy and sell money for money just like any other commodity. The payment for money is the interest rate which the seller receives. At the basic level, when you put money into your bank account, the bank is the buyer, and you are the seller. The bank pays you interest for the use of your money. The money markets have been settled to trading money. The participants of this market give or take money for a period of time, at an interest rate. The companies, the banks and the states buy and sell money in the form of certificates of deposits, bills, and bonds. These operations are made in the national currency. And after the introduction of floating currency rates, national currencies began to go on sale for foreign money. That is to say that money had become a commodity. An exchange commodity. Remember, one of the main properties of an exchange commodity is a way of gauging quality. The quality of a currency is measured by how far the national economy has developed and by the issuing its stability to meet its financial obligations. The principal world currencies. Today, almost all international transactions are carried out in 5 currencies: US dollar, euro, British pound, Japanese yen, Swiss franc. The FX market and its principal participants. Foreign exchange. It means the foreign currency exchange. Foreign currency is bought by the country's tourists, businessmen, travelers, and builders. There are ships carrying every possible cargo, and money flows around the world and exchanged for these goods. The need of foreign currencies constantly arises in people and companies in different countries, 365 days a year, 7 days a week, 24 hours a day, without lunch breaks and days off. Who works on the currency markets? First of all, there are the central banks of countries. They maintain the currency rates to optimize the economic management. Then, there are commercial banks. They manage the customers' funds and preserve their own liquid assets. Financial companies and brokerage houses represent the next group of players. They do financial asset management and work as intermediary. Private individuals, like Forex traders, are the other players of the currency markets. Companies, like Dow Jones, Reuters, and Bloomberg, collect the currency's price fluctuations and give them to the banks, financial companies, and brokerages. Although on each separate exchange, the trade session lasts from approximately 10 o'clock until 6 p.m. local time, these sessions overlap each other. So, currency trading can be carried out throughout the 24-hour period, without lunch breaks. But, we have some days off. During these days off, the stock exchange takes a break too. When this happens, banks carry out foreign exchange transactions directly with each other when necessary. Time and the currency market. Time on the currency market is the Greenwich Mean Time, or GMT. The end of the trading day is 21:30 GMT. What is a currency pair? In the modern world, it is accepted that the value of the main currencies is measured in US dollars. So, taking the 5 currencies we mentioned earlier, we have 4 pairs: USD Swiss franc, USD Japanese yen, British pound USD, Euro USD. In a currency pair, the first currency is the currency we can buy and sell. And the second currency is the currency we buy and sell it with. Taking the quotation for USDJPY tells us that today in Japan, they give 102 yen for $1. The first currency in a currency pair is the base currency. 1/10,000 of the price is known as the point or pip. If the USD/CHF goes from 1.2400 to 1.2401, you can't say the Swiss franc has risen 1 point. If you buy USD/CHF at 1.2400, and then the price goes up for 1 pip, and you sell at 1.2401, you have a 1 pip profit. The system converts this 1 pip profit to your trading account currency, which is usually USD. This profit will be added to your account. Margin. Margin or leverage of 1 to 100 means, for example, a $200 deposit works like $20,000. Different brokers offer different levels of leverage. They give you more power to trade larger amounts of currencies and make more money. However, you have to be careful, because leverage can work like a two-edged sword. It can cause you to lose your money faster too. The time to buy or sell. The important thing for you to remember is when to buy and sell foreign currency, irrespective of what the currency pair is. In the future, you will have been working using currency charts, that are the currency's price charts. On the price chart, the base currency price is drawn on the vertical axis, and time is on the horizontal. The chart shows the price of the base currency. If the price on the diagram goes upwards, it means the base currency is raising the price, and the currency it is paired with is getting cheaper. Let's take an example, US dollar against the Swiss franc, or the USD/CHF currency pair. If the chart is going upwards, it means the dollar is raising in price, and the franc is getting cheaper. The dollar as the base currency is the goods. If the diagram is going upwards, the goods are raising in price, and it is wise to buy dollars. If it is going downwards, the price of dollar is falling. So we sell dollars. In general, we should follow the price of the diagram, irrespective of what the currency pair is. The diagram upwards, it is a purchase. The diagram downwards, it is a sale. Buy when the chart is going up. Sell when the chart is going down. Now the question is, when your account is in dollars and you want to buy Euro USD, where you should get the euro from? That is very simple. The brokerage company and the trading platform will take care of it automatically. You do not have to be worried about it. Your business is to correctly identify the direction of the market, upwards or downwards. Trading platform. Internet trading terminals are becoming increasingly popular for making deals. Internet trading terminals or platforms are specially designed software for personal computers. Usually each broker or bank provides a trading terminal. The terminal enables you to do everything necessary for currency trading. All you need is access to the internet. You just download and install the platform on your computer, and you will have access to the currency trading world. Bid and ask. Each currency pair has two prices: bid and ask. Any bank on the currency market access both the seller and the buyer simultaneously. The bank is ready to sell or buy any currency from you. They are able to buy cheap and sell more expensively. The price that the bank buys at is the bid price, and the ask is the sell price. Bid is always less than ask. The reason is that the banks also want to make money. The difference between the bid and ask prices is referred to as spread. The spread is the profit that the banks or brokers make from each transaction they handle. Long and short positions. When you buy, you have a long position, and when you sell, you have a short position. You go long when the price goes up, and you go short when the price goes down. Stop loss order. Stop loss is an order that protects us from losing a lot of money. For example, when we take a long position, we expect the market to go up. However, what happens if the market goes to the other direction? If we sit and watch, we can lose all the money we have in our trading account. But we can place a stop-loss order a little below our entry level. This order closes our long position if the price goes down and reaches the level the stop-loss order is set to. Therefore, we will not lose a lot of money, and we get out of the market with a small loss. Take profit order. Take profit order closes the position when a certain level of profit is reached. It helps us not to sit at the computer and wait for the market to reach the profit we expect. It closes the position automatically when the market reaches the expected level. The broker and the trader. A trader is an individual or an organization which takes decision to buy or to sell in self-interest. And the broker or a brokerage organization carries out trades on behalf of someone else. The broker receives the commission, and the trader makes the profit. He buys low and sells high.